Singapore Airlines has sounded a note of optimism despite the global uncertainty. It says it has $10 billion in fixed deposits and another $3.3 billion in undrawn credit lines, which should help it withstand any slowdown in business. These include the potential impact of shifting tariff policies and geopolitical uncertainty. Still, the firm says the challenges ahead pale in comparison to what it faced during the COVID-19 pandemic. Kate Lowe tells us more.
More than 7 months' worth of bonuses for its employees amid a record annual profit of $2.8 billion. Even as SIA posts record profits and revenue, its CEO is looking to the future. At its financial results briefing, he highlighted the billions the firm has to weather any downturn.
It's quite clear that we have one of the strongest, if not the strongest, balance sheet in the airline industry. And this will allow us to withstand any shock that may come. As far as we can tell, the issues associated with the tariff changes and so forth are not likely to deliver a shock quite the same as COVID.
He was referring to the fresh challenges on the back of sweeping US tariffs and geopolitical uncertainties. These may impact both the cargo and passenger markets, but the airline remains optimistic, citing its diversified global network and its digital capabilities as some of its key strengths to navigate these global headwinds. This came to play when the US slapped tariffs of over 100% on China in early April.
Wherever the cargo flows go, we have the network to be able to manage that. So for example, in the days when immediately after the implementation of the US tariff on China, we were able to fill our Singapore-USA flights with cargoes from Southeast Asia rather than from China, where it was more greatly impacted.
SIA adds that there have not been any significant impacts in flight bookings. As at 31st March, the national carrier had 145 passenger planes and its budget airline Scoot had 53 passenger aircraft. This takes passengers to a total of 128 destinations. Meanwhile, the group's cargo network extends to 132 destinations. As Singapore prepares for the opening of Terminal 5 slated in the mid-2030s, one market watcher says the time is ripe for SIA to look into the next phase of fleet planning.
Other airlines are already starting to make huge orders and taking up long-term delivery slots over the next 5 to 10 years. And in an environment of supply chain constraints, delay, therefore it's crucial for SIA to stay ahead of the curve and make fleet-related decisions as earlier than previously thought.
He adds that going forward, the firm needs to better combine soft skills with technical capabilities to keep up with emerging trends.